Welcome to another conversation on Business Redefined, your weekly, most comprehensive look at the world of business, finance, and economics. We want to take a stock of the investment landscape in 2024, and we're privileged to have from Lofty-Corban, the Senior Investment Manager, Teddy Yanga. Karibu sana.
Asante sana, Julius.
Thank you for creating time to speak to us about the investment landscape, looking back pretty much a rev now into 2024. Let me start with a general assessment. When you look at the investment landscape, the 12 months we're looking behind, fixed income, equities, how has it played out?
First, thank you, Julius, for having me in this show. Looking into the investment landscape, probably the last 12 months, or we can say 18 months or so, we've had a situation whereby we've had interest rates move significantly upwards. And interest rates basically define how investments give returns. Yeah. So, for instance, our base rates, our base lending rates moved from 7% to 13%. So what that basically did is to have some effect on the fixed income market firsthand, and both the equities market to some extent. So what happens is that as interest rates move up, current investments fetch higher returns, but previously made investments kind of lose, because the underlying factor here is valuation. And when it comes to asset valuation, interest rates usually comes as the denominator of that mathematics, as you divide your cash flows by interest rates. Yeah. So as interest rates move up, you find that the asset value goes down. And it's the same thing that happens in a fixed income, specifically bonds. So if you have a situation whereby interest rates are moving up, it means that if I go into the market today and fetch in, say, for example, 12%, and then the same bond goes up to 14%, then it means that for me to exit that bond, I'll have to give bond at a discount, mainly to compensate or keep the buyer indifferent, either between coming to buy my bond or going directly to the market to buy the same bond at 14%. So that basically affects how valuations go about in terms of bond values. And then on the equity side, bonds and equities usually have an inverse relationship. Yeah. So as interest rates move on the one end, capital usually flows to that end. So as capital flows to the fixed income market, the equities now tend to lose. So now valuations again go down. I see. The same opposite happens when interest rates start coming down.
So Teddy, you're saying because you sit in the fund management space, your play for the last 18 or so months has been largely focused on the bonds or fixed income side as opposed to the equity side, or how have you calibrated your portfolio?
Yeah, so basically for the last 18 months or so, main concentration has been on the fixed income side. That is basically bonds and the short-term market, which is treasury bills, because we've been fetching some significantly high interest rates on that front, to the highs of 18%. So when
on the short term?
On the short term. Yes. So when you look at basically a rational investor will just keep equity spending until that time when it's right for those cash flows to flow back into equities.
But as 2024 rolled on, we saw inflation come down. We saw the Central Bank of Kenya cutting back their interest rates. We have seen T-bill yields coming downwards. Looking into 2025, do you expect to significantly change your strategy as you look into the market?
Slowly, we'll begin to shift the strategy, because I believe the cut in interest rates is just the beginning. Because remember, as I've said, before 2022, actually in May, around April, May 2022, it's when inflation started going up. Yeah. At that time, the base rate was at 7%. Yeah. So we've moved from 7% to a high of 13%, and then we've come back to 12%. So 12% is still on the high side. And see, this rate is being cut, or it's rather put in a place whereby it prices in inflation. Yeah. So we've seen a situation whereby inflation is easing, not just in Kenya, but across the globe. Because when you look at the factors that affected cost of goods and services, it is not a specific factor that was specific to Kenya, for instance. It's something that was spanning across the globe. And when we look at the characteristics of the global markets, we see that inflation is coming down across all markets. And we've seen the same trend that interest rates are being cut downwards to now price in that inflation level. So when you look at Kenya, for instance, our target inflation is basically between 2.5 to 7.5 on the upper end. We are currently at 2.7. So I will say that could be much on the lower end, or it's just because we are coming in from a higher base. Because usually inflation is measured year on year. So when we look at the prices of goods and services, as at end of October, for instance, they were slightly lower. Some items in the food in the basket of the inflation basket was actually lower than it was same time last year. That's why you've seen inflation significantly come down to the level to 2.7%. But I believe that will normalize going forward, because over the long term, we've seen inflation playing in the level of between 5 and 6%. I think that's basically an optimal level of inflation.
I see. One of the key defining developments in 2024 was when the National Treasury, in publishing the borrowing plan, actually gave us visibility of the bond issuance calendar. This is something we have been talking about for the longest while without seeing it. It was even part of the IMF program in terms of reform measures. How much of a game changer is this for a market watcher like yourself?
Yeah, so basically, as you've said, this is something that was not there before. Because when you look at the annual borrowing plan that's published at the beginning of every fiscal year, in that paper, they will just say there'll be a mix of bonds within these tenors and these tenors, but then they don't go to the specific of which specific bond will be issued. But now with the introduction of the bond calendar, it basically gives us a glimpse of the next 12 months of the fiscal year, because the year starts on July. So it basically gives like for the next 12 months, each month, these are the kind of papers that will be issued. Now, what this does is it provides some level of transparency and predictability to the marketer. That enables me to, for example, plan ahead. Because if I know the kind of papers that are coming in, for example, in the month of December or January or April, for me to position my portfolio to what I deem as an optimal portfolio, there are some papers that maybe I would want to buy and some others I wouldn't want to buy. So if I know a particular paper is coming in March, for instance, then I'm able to plan for it beforehand. Place my cash flows in order as I wait for that. But then also on the other hand, from the issuer side, this borrowing plan is part of a larger plan, which is the medium-term debt management strategies and the annual borrowing plan. So for them, they want to be sure of their cash flows. If you issue a bond to the market and, for example, if it's undersubscribed, you miss out on your cash flows. So it basically tells them that they can easily gauge investor sentiment. This paper is highly likely to be oversubscribed. This one, it might not be oversubscribed, so let's tweak it this way. So it kind of provides that clarity from the issuer side. Then the other thing from my end is the management of liquidity management. Because I can properly plan on where I need to place my money. So it's basically a good thing for the market. It improves on the aspect of communication, because with communication, it enables investors and all stakeholders to make decisions timely and to manage the risk of their portfolios, in terms of you don't have, say, cash flows that are hanging because you missed out or you've seen a paper that you wouldn't want to participate in. So it provides some great clarity.
But taking on that point, because the bond calendar told us we should have expected a switch auction. And for the sake of just clarities, the switch auction where the central bank, or rather the government, invites persons holding short-term papers, the T-bills, to swap them for long-term papers to create some fiscal breathing space for the government. We're expecting the first one in November. November came to an end, we haven't seen it. And I'm wondering what could be at play here. In my own expectation, perhaps it is the fact that we are seeing now yields coming downwards, and maybe the government is having a rethink because the next one was supposed to come in Q1 2025. I don't know, in your own assessment, what could be informing this kicking of the switch auction to the back burner at this point?
Yes, so basically this borrowing plan or the bond issuance calendar is a plan. So it's just an indication. Yeah. So it can be tweaked depending on the circumstances at any particular point. So right now, when it was being issued out, the circumstances then were different from the circumstances now, because the levels of interest rates that were then when that calendar was being issued were actually much higher than where we are currently. So it could be some re-strategizing. So maybe what we could be seeing from central bank is a revision of the calendar itself, because it's not cast in stone that whatever is in that calendar has to be the same thing that happens over the next 12 months. So it can be revised periodically depending on circumstances. But yes, there was supposed to be a switch, which is not there. I believe the main reason is, as what you've said, the level of interest rates have shifted from when the plan was being laid out.
I see. And in your space, which is basically fund management, how have you seen Kenyans playing out in this particular environment? Granted, the majority of Kenyans, I'd imagine, go for the MMFs, the money market funds, to be able to get some exposure to this kind of instruments you're talking about. But how do you see it rolling out in the next year?
So there's been some good level of returns coming out, especially on fixed income funds and money market funds. Because from our end, where we sit, we usually kind of try to differentiate between funds based on the risk and the risk profile of each fund and the risk profile of the client. So when you look at money market funds are very low risk investments. And the fact that money market funds had gone to the level of giving returns of 16-17%, that was abnormal. When you look at long-term returns for money market funds, for instance, money market funds usually deliver between 8 and 11%. That's the normal rate of return. So going forward, that's where we expect these rates to trend towards to. It might not be immediate because, these movement interest rates, there are a lot of factors that are coming into it because as we bring down ours, we also have to check how the global markets are responding to. If, for example, the US holds its interest rate cut, then we might have to revisit our strategy to cut, because if you don't, then it means you might end up hurting the shilling, for example. So in the long term, we see these rates coming significantly downwards. Not to the levels of where we were at COVID times. That was, in COVID times, we had the 91 day, for example, at 8.2%. We might not go there because we still have some very key risks, global risks, that could ignite or some spikes in inflation. So there's that element of trying to be cautious going forward. But all the same, within the midterm, probably the second half of the next fiscal year, we could start seeing rates actually moving back to the normal levels if all else is constant in terms of risks that could be introduced to the market. The other thing is now on the fixed income, fixed bond side, treasury bonds and so. The returns that bond funds have generated in 2024 are spectacular. Same will happen in 2025 because the trend in interest rates is a continuous process. It can't just be cut at the same time to the bottom level. So we'll still expect to see some good returns coming out of bonds, especially in the first half of 2025 and probably the whole of 2025 before everything normalizes come 2026. So we still have a journey to walk through.
2024-25 budget, the government has significantly rolled back on its appetite for borrowing from the domestic market based on the plan that is there. In fact, the plan to have conversations with the United Arab Emirates for a $1.5 billion facility is fundamentally predicated on the view that we need to tap into that external financing to be able to cut back domestically. Don't you think that will significantly change the interest rate environment domestically?
Actually, I was looking at the annual borrowing plan. There's a target for domestic and external financing, a target level that Treasury is trying to play out on, and the target is 55% domestic, 45% external. So they will play around that, because when you look at the projected numbers, for example, for 2020, for this fiscal year, the amount of borrowing that's projected, domestic borrowing that's projected, the percentage of it out of the total debt is actually higher than the last year. The last year, but it's still within the 55% range. So the thing is, we might want to go external, but the external conditions are still not yet conducive.
And they're outside our control.
Yeah. One thing that they are highlighting, or it's coming up strongly, is to shift or to give some weight to concessional financing. And I think that's something that will be playing out significantly this fiscal year. Actually, this fiscal year, we might see more of concessional financing than commercial financing, because interest rates are still elevated, especially on external financing. Looking at concessional financing, for instance, the rates that come with concessional financing is usually pegged on the SOFR plus a margin on top. So they wouldn't go past 6%. Looking at where those current levels of SOFR are. So if you have to move to commercial financing, then it means now you have to go to the levels of 9-10%, which again negates the objective or the goal of optimizing the cost of debt, that is bringing down the cost of debt for the government. So I think in this fiscal year, we still expect to see more of domestic financing because external factors are still not yet okay. That could pile up some pressure on rates, but generally, as inflation eases, then rates will remain elevated, but at least lower than where we're coming from.
I see. Yeah. And in case you're wondering, the SOFR is the secured overnight financing rate, pretty much used as a benchmark when you go to the global markets in terms of how you price the money you are sourcing from the global capital markets. Teddy, one of the key things we're expecting in 2025 is Kenya's program with the IMF comes to an end in April. And there's a lot of discussion around what does the road ahead look like. Some are saying we potentially are going for another new program. I spoke to the chairperson of the Council of Economic Advisors, Dr. David Ndia. He categorically told me that Kenya is out of receivership. We don't need a new program. What are your thoughts?
Well, when we talk of this IMF program, it might be, in terms of total financing that comes from IMF, could be a huge chunk of the total external financing that we're getting. But I think that's not the issue. The issue is, at what cost are we getting this financing from IMF? So if this concessional financing is cheaper or favorable compared to other forms of financing, for instance, cheaper in terms of, say, the rates that we're getting from it,
the tenor,
cheaper in terms of the tenor, and the grace periods that we get in terms of paying back, then I think it's an option that we can do away with, or unless we get a similar option outside the IMF.
Yes.
Yeah. So if we go for a similar,
which is hard to find, let's be honest.
It's hard to find. So what I see is I think we'll just renegotiate a new deal.
A good point there. And let's be fair, honestly. IMF de-risks you as you go to the market. So there are many dimensions to it. Foreign exchange. We had turbulence in 2023. The moment the Eurobond $2 billion was refinanced, stability ever since. How do you see it going forward?
Yes, so when it comes to currency, there are usually some short-term shocks or short-term movements and long-term movements.
Yeah.
If I can take you back to 2022, because that's when most of these things started happening, especially instability in the macro level. Remember, we had come from 2020. That was COVID times. When COVID came, most governments did or spend a lot of money to revitalize economies. So what happened is that with that money being pumped into economies, monies in people's pockets went up.
Yeah.
So that brought about inflation.
Now,
when inflation came, we had central banks now starting to uptick rates. And if I can put a point, the Fed, for example, the Federal Reserve, started hiking its rates in 2021. Yeah, that is immediately after 2020. They did hike rates from 2021 and continuously up to 2023.
Yeah.
We started hiking our rates in 2022. So there was a lag. In international finance, there is something called international international parity conditions.
Yes.
That is the relationship that exists between interest rates, inflation, and the currency. So if you put two countries, for example, country A and country B, that are at equilibrium in terms of the interest rate they have, then you have country B increase its interest rates. What will happen is capital will flow from country A to country B. That will strengthen that country's currency. So I think, as for me, that's basically what happened.
Yeah.
The US increased its rates, we stayed, so the shilling depreciated. Then came 2022, we started hiking rates. Remember, we moved from 108 to the dollar to a peak of 160.
Yes.
And then immediately started going down.
So, Teddy, just allow me to jump in there. Is it your view that the Central Bank of Kenya was behind the curve in terms of response to the inflationary environment?
I will say so.
Okay.
Because again, I have been looking at this inflation and it's two angles. In Kenya specifically, the inflation or the trigger to inflation was based on the costs of inputs.
Yes.
Initially, because in 2022, when Russia invaded Ukraine, it's when we started seeing oil prices moving upwards. Then I think it's around the same time, towards the end of 2022 or 2023, we had problems with our food. Yeah. Supply chains were disrupted. So the price of inputs went up. So that pushed up inflation. So when we now started increasing our rates, we attacked the demand side. Yeah. So inflation is up, but we also drain up people's pockets. Yeah. So it's, on the one hand, we have inflation that is coming down because of demand has gone down. But on the other hand, we also have inflation that is going down because the prices of some commodities have significantly gone down. Okay. Yeah.
I'm told we have 2 minutes to go, so let me give you an opportunity just to give us your parting shots in terms of what should the typical investment play, in your view, looking into 2025, be defined by?
So looking into 2025, I think partly we still expect to see some good returns coming out of the fixed income market, but we also have to start positioning ourselves for, say, more riskier investments, especially equities, because for this year, for instance, equities have done some very good returns across the globe. So it's an area that can provide some very good return opportunities, especially into 2025. Especially here, we've had some 2 years of negative returns. This is the first year that we are posting a positive return, especially from the equities indices, and we expect that to continue into the next year, mainly because we have we have inflation coming down. Yeah. Interest rates are coming down. The currency is stable. So all pointers are that capital will start flowing back to equities. The only problem that we still have is the performance of our economy, because these
macro.
Yeah, macro. So once we have some good returns coming in terms of earnings, especially across different sectors, then I think we'll crystallize and significantly gain going into 2025 and 2026.
Teddy Yanga giving us some snippets into what he expects to be the investment play for 2025. Of course, starting with the review in terms of 2024 and what has defined it. And it comes from Lofty-Corban, where he's a senior investment manager. That takes us to the close of Business Redefined. We have been touching on the investment landscape, a raft of issues, fixed income, stocks, the equities is talked about, as well as the global environment and what we can expect once Kenya's program with the IMF lapses in April 2025. We still wait to see what shall pan out thereafter. Stay tuned to Business Redefined for more on this and other details on the macro and micro environments.